It's good, cuzzies. Joe Josh. My chart daily, you know the deal. In today's video, I'm going to be giving you an educational course on why it's crucial to have basic understanding of technical analysis and how to read a chart and indicators and momentum when doing options with stocks. My father was an options broker for almost 20-30 years. He originally taught me this process of technical analysis and what is bullish, what's bearish, what to look for. And I like crypto because it's 24/7 and it's the wild, wild west. Not many laws and regulations right now. A lot more volatility and a lot more opportunity to make more money in the same time frame that you're trading other assets. So when you're trading options, you have to pick an expiration date and you have to pick a strike price. The premium that you get depending on those two variables goes up or down depending on the momentum of the ticker at that time. So if you're looking to short something and momentum is coming down for the day and the ticker and the asset is down, you're going to get less of a premium because you're betting with the short. Same thing with if you want to long something, right? The premium that you get if you sell that option is less if it's on a green day. So if you can have a basic understanding if on a weekly or a monthly time frame and you're looking at a play that's expiring weeks to months in advance, and you could kind of start seeing, once again, you don't have 17 years of experience, but I'm doing these one-on-one sessions to help you identify certain trigger points and give you the visuals on longer time frames, which will allow you more time to see stuff playing out in the chart. If you can see that you're getting hidden bearish divergence and bearish market structure and death crosses and RSIs breaking into different sections, stochastic RSI, once again, bearish, 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 bearish visuals. What you do is you zoom into the shorter time frame. So if you're looking at a weekly, you zoom into the daily time frame. You wait for the bullish structures to play out on that time frame, or the 12-hour or the 6-hour. You let the dead cat bounce happen and you open your short position on a green day. Your long-term short position on a green day, giving you the most amount of premium for that play. That's the overall gist of this video. Understanding the long-term trend. If it's bad, we're thinking a short, but we want to open the short on a green day, on the shorter time frames. If it's a long, on the longer time frames, we want to open that up on a red swing, shorter time swing, the 12-hour or the daily, to give you the most amount of premium. And once again, 80 to 90% of options expire worthless. So you always want to be the one that owns the assets and are selling the calls or the puts, whatever it is, collecting the premium and then making it another vehicle of income. That's what my father did. He dealt with wealthy people. He sold the calls and sold the options, collected the premiums, and used it as a secondary avenue of income for these people. Because if you could do the option 4 weeks to 6 weeks, right? That's the window of opportunity. That's technically every single month you're collecting a premium check. And if the option expires worthless, you still own the stock. If the stock goes and hits the strike price that you said that you agreed upon, then obviously you are making the money off of the growth of the asset as well as the premium that you collected from the person. Know the long-term trend, identify the long-term trend, but bet against the long-term trend on the option that you're trying to do to get the most amount of premium. Enjoy.